Hi guys, Mortgage Mark. Let's talk about whether or not it makes sense for you to refinance. If you're doing a rate and term and you're comparing apples to apples, then let's do a refinance analysis. That's where we're going to take and recreate your current mortgage, which really helps, by the way, if you send us a mortgage statement. So we can then recreate your current mortgage the best we can, and then we're going to compare it to a potential new mortgage. There is a big difference between cost and prepaids. So when we look at the comparison to realize how much you're truly going to save or not save, we want to compare just the things that matter, like the mortgage and the mortgage insurance. What I'm not going to compare are your taxes and your homeowner's insurance. Reason being, guys, escrow accounts, if you have one, they're going to change. Taxes go up, insurance goes up. I don't want to compare your low numbers to what maybe the current figures are. So we do not compare taxes and insurance in those numbers. Same thing when we give you a cost analysis. Just because you have to pay X at closing, any part of that X, those closing costs that includes your taxes or insurance or escrow payment, doesn't really count. Because whether you refinance or not, you're going to pay taxes and insurance. We're then going to do a projection to see what is the savings over let's just arbitrarily pick a 5-year plan and say, okay, 5 years from now, how much interest would you pay if you don't refinance? And then what are the costs if you do? So how much interest are you going to not pay on the new refinance? And then also factor in those costs. So we want to give you a true break even that says, okay, these savings or potential savings justify the cost in this many years. You know, if it's 1 or 2 years, no brainer, do it, assuming you're going to live in the house for longer than 1 or 2 years. If it's a 5 or 6, 7 year break even period, more often than not, guys, I'm going to tell you don't refinance. So important. Understand, we're not looking at monthly savings for the cash flow. We're looking at actual money saved in terms of interest. Now, if you're looking to do a program like to go from a 30-year to a 15-year or vice versa, it's a little bit apples and oranges. If you're taking cash out, certainly that kind of throws a huge wild card into there that's not really, again, a true comparison. But just realize, talk to a mortgage professional that's going to run the actual numbers and savings, not monthly cash flow, guys. Big difference. So if you have any questions, call us. My team and I are here to help, and we'll make sure we shoot you straight and take good care of you.